Jerome Powell and the gang to inject 1.5 trillion in a bid to prevent unusual disruptions in the markets. Not entirely surprising, somewhat expected, yet still shocking in its own right. Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, well, it finally happened. The Fed responded to the coronavirus, as you can see here, Jerome Powell and the gang, to inject 1.5 trillion in a bid to prevent unusual disruptions in the markets. Not entirely surprising, somewhat expected, yet still shocking in its own right. As you see here, the New York Fed said in a statement, these changes are being made to address highly unusual disruptions in Treasury financing markets associated with the coronavirus outbreak. Interesting wording, because you've seen a massive rally in Treasuries, although we will come back to perhaps what he's getting at here. Interesting to see, though, signs of disruption in Treasury financing market. But if we go a little farther down here, deepening rout on Wall Street had fueled constraints on financial market plumbing, which we've seen those repo lines for the last 6 months now. And here's what I find interesting. The Fed took initial steps earlier this week to boost the volume of lending for overnight repo, and announced Wednesday, that's yesterday, to increase lending to more than $500 billion from less than $200 billion. Before announcing this package today on Thursday, the Fed said it would conduct 3 additional repo offerings worth an additional $1.5 trillion. And if the transactions are fully subscribed, that would swell the central bank's $4.2 trillion asset portfolio by more than 35%. So people were expecting QE, and today it arrived. We'll see whether this ends up being called QE, but it's here. I don't think there's going to be anything temporary about this, because in the end, I mean, the market's already collapsing with rates going down in QE. I mean, it's not like they're going to raise interest rates the next quarter. But going back to what we heard about the bond market, did find this interesting. Here was on Monday when the yield actually hit 0.3%, and liquidity issues in which buyers and sellers are having a hard time coming together on prices are just part of the problem. And Steve Leisman, Michelle told Steve Leisman, I've been doing this for 40 years. I've never seen this before, in regards to Steve Leisman, who inquired about a half-point difference in what buyers were willing to pay and sellers were willing to sell for. So certainly worth keeping an eye on that there is any sort of thing like that happening in the Treasury market. Did see an article here on, again, this was going into the Fed announcement. Again, they mention highly unusual disruption in the Treasury financing market. So let's see. Yes, and here we go. Here is what was behind yesterday's unprecedented Treasury dislocation. The Treasury market is on the verge of breaking. We asked if a big macro fund got carried out, especially after the unprecedented divergences observed between cash treasuries and TLT. So rumors of a fund getting blown out certainly wouldn't be shocking in this kind of environment with the size of moves we've seen. We'll keep an eye on what's going on with the Treasury. And if you're wondering how the gold and silver markets have reacted to this, just stay tuned, because the next video coming your way gets into exactly that.